Hello, can everybody hear me? Maria, can you just let me know if my audio is working well?
Yes.
Okay, great, thank you. Hi, everybody. This is Steven Simmons. Some of you might already know my name or have heard me do presentations before. I'm the CEO of Wavebasis and also the engineering. I did all the engineering and built the software. I just want to first welcome everyone and thank you for coming. Let me get to my next slide here. Bear with me while I get everything set up properly. So thank you all for coming. It looks like we have a really nice sized group here. I also want to thank you guys because almost everyone took the time to fill out the survey that we had on the registration page. So based on your responses, I'm going to talk about the topics that you see here. I also want to say the goal of this webinar is to empower you to be more successful traders. It's really that simple. So I'm going to talk about some of the core essentials of successful Elliott wave analysis with some practical examples covering the markets that you guys selected. By better understanding these core essentials and how to use Wavebasis to apply them, you should all leave this webinar ready to directly apply what you've learned to improve your trading profitability. I'll also say that if you have any questions as I'm talking through the examples here, please feel free to use the Q&A feature on your Zoom app. We'll be keeping a close eye on any questions that come in, and I'll try to make sure to address as many as I can. Also, please keep your questions relevant to these topics that you see here. And also always feel free to contact us via customer support for any issues or questions that are really outside of the scope of what we're going to talk about today. Also, I'll mention at the end of the webinar, we're going to offer a nice juicy discount that can be used for new subscriptions or upgrades. So make sure you stick around to the end to receive that. Okay, so again, welcome. Let's get into it. Today, we're going to cover the topics that you see on the screen here. First, we're going to talk about a little bit of grounding. And I'll explain what I mean by that in a minute. Then we're going to cover, as you see, what are the steps to apply Elliott wave analysis to any market? How do you choose the wave count? How do you choose the right wave count? And how do you analyze multiple time frames? And based on your responses, the overwhelming majority of folks who registered and completed the survey were interested in US stocks and to a lesser degree, metals, Forex, and cryptos in that order. So let's get into it. Okay, first, if you've heard me do presentations before, you've probably heard, you've already heard me speak about this, but I just think it's important, especially for newer Elliott wave analysts or even newer traders in general, to really get grounded in and get it clear in our minds what it is we're attempting to do in the context of trading in general and in the context of Elliott wave analysis in particular. First, trading is a game of skill and probability. It's not random chance. So, it's easy especially for newer traders, when you look at a chart of a market, a lot of traders approach it the same way you might approach a casino game. That you see this squiggly line and candles and bars on your screen, and you think you're placing a lot of traders think they're placing a bet on an abstract external quantity that's just going up and down according to some rules that we don't quite understand. It's separate from any real world phenomenon. Well, this is not the case. Markets are driven by human sentiment and the activity that flows from that sentiment. It's an actual real world phenomenon. So when you see a market going up or down, markets go up because enough people think it should go up. It's really that simple. So a crowd of people, market participants, if enough of them believe that a stock price or a Forex price or crypto or anything should go up, it will go up. So what we're measuring is actual human activity. It's not a random thing like a roulette wheel or or something in casino. Again, I think for me anyway, and for a lot of the traders I've spoken to, this helps to understand that this is again a real world phenomenon. As what Ralph Nelson Elliott observed, and many traders have benefited from his observation, human sentiment and the activity of market participants evolves in repeating cycles, or what he calls patterns, or what we call patterns. Elliott wave analysis is simply a way, Elliott wave analysis itself provides a way to measure these patterns. It's a kind of scaffolding on these patterns of human sentiment and activity. And going one step further, wave basis helps you identify these patterns, understand the probabilities that are related to them, and learn to apply the skills that skills and knowledge that you get from the core Elliott wave analysis, Elliott wave principles themselves. So what we're doing when we apply Elliott wave analysis is actually quite simple and aligns with common sense. It's not magical and it's not something strange. It's I liken it to, I think it's similar to tracking a natural phenomenon like a hurricane. You take observations and you make predictions based on probabilities. It's really that simple. It's simply a way to measure patterns of human activity and rely on established probabilities related to those patterns to make accurate forecasts and profitable trades. And if I can do it, you can do it too. So let's get you empowered to do that. Okay, so now that we're all grounded, let's get into the meat of it. What are the steps to apply Elliott wave analysis to any market? And this is, I've found, or we found over the years since wave basis has been out in the public, one of the most important things that traders often miss is understanding that Elliott wave analysis is best practiced by first establishing a long-term wave count for an overall market, and then drilling down or zooming in further. And we'll go into more detail about this sort of general concept that I'm laying out now. Drilling down further to identify trades based on your expectations for trading, the trade time horizon. So it's sometimes I think metaphors or analogies are helpful. We've also written about this on the website. It's very similar. Practicing Elliott wave analysis to make forecasts and identify trading opportunities is very similar to zooming in on a map. So when you are trying to plan a road trip or something, or you're going to drive somewhere, or maybe you're in a new place and you're going to walk somewhere, you first you get an overview. Where am I? Where's the place I want to get to? And you get a sort of a general context of the trip that you're going to take. And then once you understand that, you zoom in further to map out the turns that you're going to take to reach your destination. Elliott wave analysis is very, very much like that. And this also relates to the question of where should I start a wave count, which is, again, one of the biggest struggles that folks tend to have. So if you're planning out a trip, you don't zoom all the way on your map and just pick a spot and start trying to map it. You have to understand the beginning of your trip to the end of the trip to give yourself the overall context, and then all the steps that you have to take in between to reach the destination. Elliott wave analysis is the same thing, same way. So we're going to establish a long-term wave count for overall market context. Consider alternate wave counts, and we'll talk more about that as we go. Then once you've established your long-term market context, your long-term wave count, save it, put it aside for future reference, and you'll want to refer to that as you move down to smaller time frames to plan your trades. And I say this because, and again, this is in our documentation material as well. One of the other mistakes that traders tend to make is they keep running the same wave count over and over again, seeming to expect something different to happen. That's a mistake. some of so I'll get so some for an example for that as an example, some of my long-term wave counts I've had for years, and I've never run that. And you'll see some of those today, some that I've shown in previous LA Wave events. Once you have your if you're looking at a map planning a trip, once you have the overall context, you don't have to keep going over it. You may need to zoom in, as you start your journey to your destination, you may need to zoom in further, make some adjustments. There's a road closed there. I've got to take a detour or go another way to reach my destination. But you don't keep going back to the beginning and planning the trip again. LA Wave analysis is the same way. Get your long-term market context, put it aside, and you shouldn't expect it to change very, very quickly. And we'll talk a little bit more about that in a bit. So once you have your long-term market context, decide on your trading horizon. It might be that that's all you need. For example, if you are a long-term investor, maybe you're planning for retirement, or you're not an active day trader, or even a longer-term, short-term trader, you may see a trading opportunity. Well, this looks like a stock that I want to own for 20 years. That's all you have that information just from the long-term market context. If you have interest in trading shorter periods, maybe you're a day trader, maybe you are a faster intraday trader where you're in trades hours to days, maybe you're trading days to weeks, weeks to months, so on and so forth. That's when you zoom in, as you would on your map. You zoom in on the wave count to smaller time frames to evaluate the LA wave patterns more closely. And to do that, we use the tool at WaveBasis. We provide tools like counting subwaves or time frame drill down to refine the count at smaller time frames. But the overall important thing here is that you're going to be looking at the same wave count all the time. You're not picking different starting points. It's always going to be the same count. One market, one wave count. And you zoom in to find trades at smaller time frames. So let's take an example. I'll show 3 examples here in increasing difficulty. So the first one here, we're going to look at the US dollar, Mexican peso. So obviously a Forex market. And we have obviously an empty chart here. And the first decision you'll have to make is, what time frame am I going to look at here? Pardon me 1 second, get my notes. What time frame should I look at to establish this long-term market context? It's either, generally speaking, going to be a daily, weekly, or monthly chart. Now, how do you choose between daily, weekly, or monthly? This will be determined by the length of time the market has been trading. So for a stock that just started trading in, 2021, you might be able to get away with a daily count. For something that's been trading since the 70s, you may need a monthly count. The general rule of thumb, there isn't a hard and fast rule about what time frame to use. The general rule that I tend to use is, if I can see the entire history if I can't see the entire history on my screen, then I should probably move to a higher time frame. So for example, if we look at a daily chart of the dollar peso, I can't really get I want to be able to see the entire history. I can't do that with a daily chart. So I go to a monthly chart. Weekly chart. And I can see this whole history, and I'm going to run my wave count using the weekly chart. What I'll also mention at this point, but no, I'll save that for later. So let's just run the wave count. And what do we get? Now, the reason I called this the easier case is that we see that we've gotten a wave count that just on visual appearance looks pretty solid. Some people refer to this as the right look. And what we see is we have a 1, 2, 3, 4, 5 up, and 1, 2, 3, 4, 5 up to complete a wave 1 and the completion of wave 2 and a rally from that point. Once you have experience, you will be able to look at a chart like this. For example, obviously I have a lot of experience. I can just look at this and know it looks pretty. It's pretty solid count. And we'll talk about it. I'm not going to look at the alternates right now, but we'll talk about that on the next with the next topic, and how to evaluate them. Just to keep this topic focused on the overall process. This is the starting point of the process, a full history wave count, and you want as much history as you can get on a given market. In this case, and I'll just step forward a little bit more into the analysis of this count and how I tend to use, or how we recommend using some of the SMART tools. For example, the SMART support and resistance tools are extremely powerful for informing you of the probabilities associated with wave patterns. So, for example, on this count, once we have this wave 1, let me hide some of the tools so it's more clear. Okay, so for now, I just have my SMART support and resistance tool turned on. Once we have this wave 1 up, the question we will have is, well, where would we tend to expect wave 2 to occur? And we would expect wave 2. These are not predictions. This is probability based on a combination of long-established Elliott wave and agreed upon Elliott wave expectations with regard to Fibonacci levels. We have combined that with a lot of research. So these colored boxes, the SMART support and resistance areas, are just probabilities. This is what we would tend to expect. We would expect wave 2 to end up in this area here. And I'll step forward a little bit further. Then once we have wave A and B in place, we can check to see, well, based on wave B, where would we expect wave C to be? Well, we would expect it to be right there. And we have overlap. I'll talk more about this later. We have these two colored boxes are now overlapping, identifying another high probability area for the bottom of wave 2. Further, we go down one more degree, we can see based on wave 4, where would we expect wave 5 to be? So here we have in this example, and this is obviously a great example. It's a one click and it tells you with what looks to be a high degree of certainty that we would expect based on the overlap here. This is you can see this area where my cursor is now. This is where all 3 of these colored boxes overlap. It's an overlapping probability. We would have tended to expect the bottom to be right there, and there it was. Or so far anyway. This can always turn and develop a different pattern, but for the time being, it looks like we have a strong rally from where we would statistically have expected the rally to occur. So, as I said, this is an easy example. All markets that you look at and try to get a long-term market So to put into simple words, based on this wave count, we can say that we've established a long-term market context. We have bottomed in a wave 2 and are now rallying in a wave 3. That is our context. And as we can drill down in here, we'll talk about that in a minute to see if we can find some trades. So I was starting to say that this is, as I said, is an easy example. All markets that you look at aren't going to be this clear. This is easy is not the right word. This is a very clear wave count. Okay, I'm just looking at some questions coming in. Okay. Okay, there's an interesting question here. I'll come back to that. But I'd just like to say that this is a very clear wave count. All wave counts aren't going to be this clear. for me, I look for wave counts that are clear, because clear wave counts will just naturally tend to give you a more statistical, more probability based edge. So the point that I think the takeaway point there is, don't force it. If you don't have if you can't get a clear wave count on a particular market, unless you are forced to trade that market, maybe you work at a company that tells you you have to trade a particular market. There are plenty of markets. There are plenty of fish in the sea. I look for wave counts. I'm market agnostic. If I see a clear wave count, that tells me I have a high probability of finding a successful trade. So as I said, this is not magic. It's just probability. You get higher probabilities of success from clear wave counts. So look for them. So we'll go up in difficulty. Let's see what was mine. Let's go back. We're going to look at Ethereum. Where are we here? Okay. This is, actually, let me complete that dollar peso example. Where were we? Here. And so what you can do is, once you have this wave count, you can just save it. Forget about it. If you're a long-term investor and you want to hold dollar peso for a while, looks like now is a good time to buy it, because according to this wave count, we're heading up in a wave 3 that we would expect to be off the chart, essentially. Let's see, where would wave 3 be based on that? We're going to expect dollar peso to rally to around 50 from here over the long term. If you're looking for a shorter term trade, we'll talk about that in a minute. You zoom in. So let's look at Ethereum. This is my account for Ethereum, and we'll look at how I got that. Actually, we'll start it from scratch. And we'll talk a little bit about the alternates. It looks like in this case, we may or may not need alternates. Excuse me. So I consider this a medium difficulty, medium clarity with the first wave count. Again, is quite solid from a visual inspection standpoint. And we'll talk more about analyzing more deeply individual wave counts. What we have is a 1, 2 here, and a subdivision of wave 1 here, with a drop for wave 2, and a rally from that point up. Let me bring my notes. Sorry, I'm just reviewing my notes. So I don't want to miss anything. One thing I wanted to emphasize, that especially if you're just learning how to do this part of the Elliott wave analysis process, that is establishing a long-term wave count context, feel free to send us your wave counts for feedback. I see a lot of folks struggling and trying to find the right starting point and not sure about wave counts. And you'll find that once you can do this part, once you can get the long-term wave count context, it's going to take you a long way to having consistent, reliable trades. So feel free to send us your wave counts for feedback, and please have some patience, because we may get with that. Now that I'm saying this publicly, we may get flooded with wave counts. But and also please keep in mind that wave basis, we're not advisors. We're happy to give you feedback on your wave counts, but we're not going to tell you how to trade. That's just not what we do. Our aim, as I said at the beginning, is to empower you. So in this case, again, this moves into the next topic. So let me get that up. Actually, before I do that, one more example. This is, and we'll come back to these markets. Another example is, this is a more difficult wave count. And I'll show you, starting with this, I'm going to look at NASDAQ. And this example flows from, if you watched the last webinar that We recorded at the LA Wave Hub event in this past February. You may recognize this wave count. In this case, I have been interested in the rally from the end of 2022 and have been counting it this way. At the time that we did that LA Wave Hub event, we were trading in this chop, looking for this wave 4 drop, which we got. If you go back and watch that video, it's a day trading example. Based on the same wave count, I have not rerun this wave count. I'm just evolving it forward. This count is telling us that we're heading up into what looks like a top of a wave 5. I'll also mention, however, that there are alternates to how to count this rally. This is my current primary wave count. So as we can see, we are approaching not only the expected area for, as according to probability, for wave 5 to end, we're also going to be bumping up against the top of this LA wave channel. Now, the reason I say this is a more difficult example because NASDAQ is a market that has this. We're looking at here is NASDAQ futures. So if you're a futures trader, this would be an interesting chart for you. The problem with NASDAQ futures is it doesn't show us the entire history of the NASDAQ. So it's difficult in this case, unlike, for example, the dollar peso that we looked at, it's difficult to use NASDAQ futures to get the complete long-term context for the NASDAQ index. In that case, you have to do a little bit more work. And in this case, we can look at the full history of the NASDAQ that goes back to 1971 and understand where we are in the overall context. So the futures chart that we just looked at is the daily chart of this rally from 2022. So as I'm looking at this chart, and this is interesting this is useful and interesting for shorter term trades. As we approach the top of this wave 5, of this 5-wave move, the question has to become, okay, we're completing a 5-wave move, which is in Elliott wave analysis, the top of something. It's either going to be a top of a wave 1 or top of a wave 3 or the top of a wave 5. Which would forecast a drop from there. So the only way to know, or the best way to know how large a drop we should expect, assuming we get a drop, because as probably everybody that follows U.S. stocks knows, we're in a bit of a mania period now. So this may not stop here. This is just the highest probability place for it to stop. But the market seems to be very excited. And as we said at the top, markets move based on human sentiment. So if people are excited, they could keep rallying it well beyond what we would expect in a typical probability sense. So the question becomes, how far will the market drop from here? We can answer that question by looking at the longer term context. So if, for example, and I find this chart interesting because if you squish it in and get just a visual sense of what this market looks like, we've had sort of a parabolic rise, and now we're going vertical. And typically, markets that go vertical drop the same way. So who knows how far up it's going to go, but something to keep in mind. Excuse me. So in terms of answering that question, how far will the market drop? Well, we're already outside of the upper edge of the LA wave channel here. We are in the area where we would typically expect this. Go in a little closer. This is the same wave 4 that I showed on the NASDAQ chart. We're in the region where we would expect that wave 4 to end at the same time as we are hitting the top of the channel. But again, manias, which I would consider this one, can go on indefinitely. But it's useful to know what the probability, the typical behavior would be expected from here. So I hope that's helpful. And as you see, I've saved this as a long-term master. just to, and I have to touch this wave count very, very infrequently. Obviously, a monthly count. I don't need to run this again. I just save it and look at it when I need to refer back to it. Okay. So how do you choose the right wave count? So now that you understand the first step is long-term wave count context. Establishing that long-term wave count context involves some steps, and it might, as we'll talk about, involve looking at alternate wave counts. So evaluate the clarity and reasonableness of the wave count. Use your brain. Take a look at it. Does it look right? As I said, this is what is typically in the LA wave world referred to as does the count have the right look? One of the features in wave basis is wave count bias. You can use wave count bias to refine and improve your probability of isolating the right wave count. And this NASDAQ chart, maybe this is a good example of that. For example, if you know that, as we do in the case of NASDAQ, that we're in a long-term uptrend, this is an excellent opportunity to use the impulsive bias. Now, what this does, you can think of this the same way you would think of using a search engine like Google. When you run a wave count, it's essentially like performing a search. You're asking what wave basis is to search the market data, look at the price series, and find patterns. When you use a neutral bias, wave basis will be looking for all sorts of patterns. Corrective patterns, we'll look at it's going to be first looking for the long-term context and then filling in the details of the subwaves. It's going to consider maybe this is a corrective rally, along with considering, well, maybe it's an impulsive rally. In cases like this, where I don't think you'd find much disagreement that NASDAQ is in a long-term uptrend, it is useful to use the impulsive bias. And what that has the effect of doing is narrowing the search that wave basis has to do. So what in this case, instead of considering, well, maybe this is a corrective rally, it's not going to consider corrective rallies. It's going to only consider impulsive rallies, with this being the direction of trend is up, which has the effect of refining the search and improving your overall probability of finding the correct wave count. And so this is how you, as the analyst, can participate in the process of identifying the correct wave count by driving wave basis with the bias feature. Give me a second. I'm just going to, I see a bunch of questions. And give me a minute to review these questions in case anything is related directly to what I'm talking about right now. Good question. Okay. Okay. Most of the questions I'm seeing here are included in what I'm planning to talk about, so you'll get answers as we go. Okay, back to the slide. So that was wave count bias. Use the SMART tools to assess count integrity at multiple degrees, and we'll talk specifically about that. Consider market context and indicators, and we'll talk about that. And so I'll dig into what I mean by using the SMART tools. Indicators, obviously there are thousands and thousands, endless indicators that folks use for trading. Some of them are great companions to Elliott wave analysis. In my particular case, I keep it very simple, and from top to bottom, my approach to Elliott wave analysis is just keep it simple. And the only indicators that I use are simple momentum, RSI, MACD, and volume is always important to get a sense of context of what the people are doing, the human beings that are driving the market. And I also use highly correlated markets to help clarify counts, and I'll show you an example of that. And of course, consider alternate wave counts, and then repeat this process with each wave, each alternate. So let's take a look at silver. A lot of folks wanted to see metals. Okay, this silver wave count shouldn't be, if you watched any of the previous webinar videos, you'll recognize this count because it's the same wave count that I've been using for about 2 years. Let's get some detail in here without too much. So what I'm interested in here is the rally from 2020. And I should, I guess, show the long-term master that I had for silver. I have that in here. It's the medium term. Let's look at the weekly. This is the overall context. And so one of the things that I do, once I have established the long-term, the long-term context for a market, I will tend to focus, just keep it in mind. I don't need to see this every time I open a silver account. I don't need to see, from 2000. So what I tend to focus on is I will start a new wave count, and you can see I call that the medium term master, and I'll just start counting up from here. But I know in my mind that we're heading up according to my long-term wave count context, that we're heading up in a long-term wave 3. But I don't need to keep seeing this over and over again. And so this is the starting rally from 2020, just in case that's not clear. I'm starting from here and starting a new wave count from this starting point. This is a long-term, apparently, so far, it appears to be a long-term bottom, and we're rallying up from there. So that's a great starting point for analysis, for forward analysis. I won't go through this in too much detail, but because it's already covered silver, I won't go through the last couple of years of silver because it's already in those previous webinars. But I'll just mention, as you can see here, similar to what I showed you on the peso dollar, you can see that we would have expected wave 2 from this 5-wave move up, 1, 2, 3, 4, 5, and let's talk a little bit about assessing the wave counts. It's a good spot to do that. Yeah, okay. One of the things that wave basis helps you do is assess the probabilities that, that is this a legitimate wave 5? I mean, sorry, wave 5-wave move to complete a wave 1. And we can look at that by looking at the internal, the probabilities associated with the internal subwaves. So in this case, we can see that from this little wave 1, 2, we would have generally expected the wave 3 to end in that blue box there. Now, it didn't. It went through that box. That's okay. This is still information. Again, this is not a prediction. This is where we would generally, on average, expect wave 3 to terminate. If wave 3 goes beyond there, that tells us that we have a strong rally happening. And this is great information if you're actually trading. If you're back in 2020 and say, okay, now we're above. If I'm long here, or maybe I'm still thinking about trying to jump on this wave 3. When we get up here, we know we're in a stretch, an overstretched wave 3. That's solid information. So we start looking for potential Fibonacci levels to stop that wave 3. So again, it's really important to have in your thoughts that these colored boxes, in the wave basis terminology, the smart support and resistance, are not predictions. They're just information, and it's extremely useful information, as you will find out. And I'll show you some examples here. So the other thing that this tells you, that if you're trying to work out the detailed subwaves of a section of a chart, if you're beyond the average expected area for wave 3, more likely than not, the next meaningful drop is going to be your wave 3. We don't have to worry too much that wave 3 went up here. This is likely it. Again, it's probability. So breaking down these subwaves, and I'll show you. Hopefully, we'll get to more examples of this. I'm already talking long. I always tend to talk too long, but hopefully, this is helpful for everybody. And we can see the same thing happen in wave 5. And that happens, anybody will tell you, metals and cryptos have, throw this out there, have a long history of having extended wave 5s. Typically, when you see, these crazy rallies in metals or cryptos, you're seeing wave 3 of wave 5. And that's what happened here. Same thing. We had wave 3, the next highest degree. We would have typically expected that wave 3 to end here. Again, the strong rally continued. Obviously, you don't see these kind of rallies in every market all the time, but we saw it in silver in 2020. Again, once you get beyond your average expected, the highest probability zone, you're going to expect the next meaningful drop to be your wave 3, and there it is. When we had wave, and we're going to look at this wave. Let's clear out some of this. Maybe it's getting hard to see. And we can see again that the wave 4 here stopped exactly where we would have expected it to. This can give you confidence. So when I should say the smart support and resistance tools have a kind of a twofold role. On the one hand, they can help you assess the history of a wave count. This gives me confidence. Wave 4 was expected to stop there, and it did. So as I'm building and deciding between wave counts, that sort of thing, the more of that, for example, that you see in a particular count, the higher confidence you can have that you're working on the right count. The second role for the smart support and resistance tools is obvious to give you a sense of what's happening and evolving action. What's it going to be happening in the future, and we'll look a little bit more of that in a minute. So just walking forward here, based on this wave 4 drop, which hit about where we would have typically expected. It spiked out of there, but we had this acted as the resistance that we would have expected. Where would we have expected wave 5 to be? Let's see. Right where it was. In general, for forecasting wave 5 is one of the things that I love and have grown dependent, not I would say dependent on, but it's part of my regular routine, is looking for wave 5s. You get really great opportunities from these support, these resistance areas from the smart tools, combined with the classic Elliott wave channel. You can see that, right in there is where we would have expected, either here or further up. It could have gone higher, but in this case, it didn't. It hit this intermediate band for the Elliott wave channel. It was great. Working forward, we would have expected wave 2 to land in this area. Once we got our 5 waves for wave A, and we got our wave B, about where we would have expected it. Where would wave C typically end up? Right here, we got overlap formed. It served as the resistance we needed to stop the drop and start a new rally, which I've talked about in previous videos. This rally has continued to unfold exactly as expected. I think I started talking about silver in 2022 when we were around in here, I think. Has continued to just confirm itself moving forward. Same thing here. Where's wave 2 going to be? Where's the confluence area? Overlap there, and we keep rallying. And so moving forward, expecting wave 4 to end, have finished already, or maybe end a little lower in here, and then rally up. This is how I'm trading silver, or how I'm tracking silver. Again, let me refer to my notes. One of the things I mentioned here, we talked about using the smart tools to assess account integrity at multiple degrees. And the smart tools that I just used in that example, and the ones that I use most heavily, are smart fibs, smart support and resistance, and the smart Elliott wave channels. We'll talk about here on context and indicators. Let's look at this NASDAQ chart again. So as I said, based on this wave count, I'm expecting some sort of top soon in the NASDAQ. Now, what else can what else can we see here? And you can see that in the indicators. One of the things that a lot of people look for, including me, is divergence around major turning points. Divergence in RSI, this is RSI, this is MACD. And as we can see here, we have divergence that started about a year ago, where market made a new high here, and we have new highs in both RSI and MACD. And as the market continued to make new highs, we have divergence. This is a little lower than this. This is a 79.5, this is 79.4. So we have the market made a new high, and RSI and MACD didn't. And now we have another opportunity for divergence, but we'll have to see what happens. Maybe this will get stopped around now. MACD is continuing. You can see lower peaks in MACD. So far, lower peaks in RSI. That's the divergence that we look for around turning points. So that's just a little bit more information that you can use to build confidence in a wave count. If you see, for example, if we see as the market is making new highs through this rally, you're continuing to get new highs in RSI and or MACD, well, that's going to take away your confidence that you're heading toward the top. We have pretty good reason to expect that we're topping here, but it doesn't have to. This can continue up to make a new high, and we'll have to reevaluate at that point. And that brings up one point. One of the other things that seems to confuse folks is, they write in and say, well, the wave count changed. And if I find it, and I understand the confusion, but I find it interesting because that's the point of LA wave analysis. What we're doing is reading the market and formulating forecasts as new data arrives. Again, very much like tracking a hurricane. When a hurricane first kicks up, you have some general ideas about how fast it's going to go, how much rain there will be, how much wind there will be, where will it hit land. But you don't really know all of that unless you are measuring the hurricane as it continues to develop. Elliott wave analysis is no different. You should expect your wave counts to change, particularly at smaller time frames, and be flexible in your thinking. You're constantly reading the market, evaluating what has happened, updating your wave counts to match what you're seeing. And obviously, Wavebasis does most of that for you. But don't be surprised if your wave counts change. But always keep in mind, you always want to have your starting point meaningful, as in this case. And I've already talked a little bit about this. I was interested in the rally in the NASDAQ from October 2022, corresponding to this leg here. If you haven't already read it, please read the article on our blog called "Where Should I Start My Wave? Where should I start an LA wave count?" to reinforce this idea. If you're using Wavebasis now with a fixed window, 600 or 1,000, or whatever the different ranges are, stop doing that. Start picking your starting points deliberately. And the article on the blog talks you through this in detail. Let me again just consult my notes. RSI MACD. Okay, let's take a look at this slide. Use highly correlated markets to help clarify counts. Now, in the case of silver, I consider this a quite clear count. Because we're getting, where would we have expected that wave 3? Well, about there, that looks good. Where would we have expected that wave 5? Right there, and sure, there it was. So these again, probabilities, if based on this wave 2, where's the highest probability place for wave 3 to stop? Right around here. Looks good. It's not perfect, because probabilities are not perfect. It's just information. Where would we have expected this wave 5 to stop right here. And so it did. So this is, I consider this a very clear wave count. And I consider that, one, because it looks right. It has the right look. This is the classic sort of test. If we were looking for a 1-2, it's going to look about like that. 5 waves up, 3 waves down. There it is. Number 2, it conforms with probabilities that we would have expected it to conform with. So that gives us confidence, and that was in a couple of the questions that have come through. Where does all this confidence come from? Those are the tools that I use. But actually, no, I won't look at that. Back to the slide. Correlated markets. In the case of silver, as I said, this is a pretty clear wave count, but it can also, when a wave count is not clear, sometimes you can get clarity by looking at a highly correlated market. In the case of silver, I use PSLV. If there are any questions about a wave count, if I'm in doubt about something, this is not actually one of those cases, because the PSLV count is identical to the silver futures. In the case of the NASDAQ, I use QQQ to resolve any conflicts if I'm not sure. This is especially on shorter term wave counts. I'm looking at QQQ 5 minute, like same thing. I'm looking for a top around now somewhere. So just keep that in mind. If you're not finding that the kind of clarity from those 3 things I just mentioned, look at a highly correlated peer to the market that you're interested in. Sometimes the counts are going to be different, and that can give you information. Let's see, alternate wave counts. So let's back up and see what we get if we start from scratch with silver. Again, from that 2001 low. Oh, okay. Okay, so we have, this is our primary count. And for those of you who may not be familiar with how the alternate wave counts gadget works, you get a primary count, then you get 3 alternate counts. This percentages here, this is something that we came up with that is we call it the similarity index. Now, what we see here, and the waves and the bullish bearish forecast is based on the highest degree pattern in the wave. In wave count. And in this case, the highest degree pattern is this cycle pattern, the orange cycle pattern. So all of these are showing bullish impulse wave 3. So that's referring to this wave 3 here, the big orange wave 3. Which we can look a little further. We can see that's projected to get up into the 80s. And maybe I did that fast sometimes, and because people do ask about this. If you're hovering over a wave and you're looking, well, where's this marked support and resistance? Sometimes it's off the chart, so you just have to adjust your y-axis to find it. Hopefully that's clear. So let's look at another one of the other wave counts here. Okay. Now this is the overall structure is the same. It would have a big 1-2, a subdivision 1-2, and the difference here is that this is being counted as a 1-up. Well, that doesn't really have the right. It could be a 1-up. There's a weird looking leading diagonal or something in there, but it doesn't look great. This looks quite a bit better. Again, we're just using the same tools I just talked about. This is and we can look more closely at this on a daily. I was hoping to keep this around an hour, but I'm going to go longer than that, it looks like. So hopefully that's not too long for you guys. Because I still want to talk about multiple time frames. And we can see, and we can use tools like counting subwaves to get a little more detail. So this, if we're questioning whether this is a 1, 2, well, we can get the detail on a daily chart and see that not only is it a clean 1, 2 at 1 degree, where wave 3 hit where we would have expected it, and so did wave 5. Again, this 5-wave move conformed to expected probabilistic expectations. Not only did this confirm that we had a deep wave 2 there. Deep wave 2s to the 786 are not uncommon at all. Don't be afraid of them. Be cautious at all times, but just because a wave 2 gets below a typical sort of 618 area there, doesn't mean it's not a solid wave 2. Not only did we get some solid confirmation that this is a clear, again, in the context of clarity, a clear wave 1, we can see that at 3 more degrees of all the valid Elliott wave patterns, it looks like a mess, but it's a big, beautiful mess, because we can see at 1, 2, 3, 4 degrees of the pattern, we have valid Elliott wave patterns. A lot of them are probably confirming at the support and resistance that we would have expected statistically, but we don't really have to look that closely. In some cases, you might, particularly if you're looking at, the end of a wave count and you're trying to trade at this level of granularity. But historically, I'm pretty convinced by what I just talked through that we have a solid 1, 2 here. And counting up from there, we can see that this alternate, let's continue walking through the alternates. Actually, let me go back because I ran some subwave counts. Let's get the long-term alts back. This is alternate number 1. We're on a daily, and we can see the difference here is that we're counting a 1, 2, 3. With both these counts, both agree in terms of this 1, 2 here. With solid, good confirmation of the probabilities. The difference we can see between 1 and 2, and 1, especially when you're starting to get comfortable with looking at wave counts and evaluating wave counts, you might want to see them side by side, for example. You can easily do that like this. So now we can see that the big difference between this count and this count is what happens after this wave 2 bottom. This one we're showing a 1, 2, 3. This we're showing a 1, 2 and a subdivided 1. You can look at another one. We have another interesting wave count. Again, this doesn't quite have the right look. This could be, it could be, but I'll just tell you why I like one of the other ones better. Again, this is, and you will see this happen sometimes in wave bases. What we're seeing here is this is being counted as a 3rd wave. Now, why do we not like that? Number 1, if that's a 3rd wave, it could be, and you will see this, for example, in ending diagonals, where you'll see a very short wave 3 and a short wave 5 for an ending diagonal. Now, why do I say that's a short wave 3? Because based on this wave 2, we would expect wave 3 to be way up here. Now, unless you have reason to think that coming off of a long-term bottom like we have here is going to start up in an ending diagonal, this is not the count that I would choose. number one. It's a short wave 3. Number 2, it doesn't really have the right look. We can see that at 2 degrees, this counts as valid. But if we were to try to count this as one of the most important rules of LA wave analysis, you can't have overlap in wave 3, and wave 3 has to be a clear 5-wave impulse. You can see that here. If we try to count that, let's see if we get. Well, no, we can't even find a valid way to count wave 3. And when you see this, it means that when you don't see labels on a section, when you don't see wave labels on a section of a chart here, and especially on a wave 3, it means that wave basis did not consider that very closely. It said, well, hopefully this doesn't get confusing. What may be the case in some instances, I would say, until you get really comfortable doing this, I wouldn't go this far. What you can do here, we're looking at a daily chart. It's conceivable that if we move this down to maybe a 15-minute chart, you can get a valid non-overlapping wave 3 out of this, but it just doesn't have the right look. Wave 3 at the blue degree here at the intermediate was short. It's just not a well-structured count. So I'm not even going to consider this one. Short wave 3, wrong look, bad subwaves. So let's go back to this one. So far I'm interested in this one, but it's still not quite right. And this sort of gets us into the next topic. Let me just make sure I covered and consider alternate wave counts. So that was, in considering the alternate wave counts, you're going to do exactly what you did when we talked about how to choose the right wave count. Just going to go through, repeat the same process with each count, using smart tools, using the right look, making sure that you just don't see crazy things like we saw in that last count I looked at. Now this has promise, and we've already looked at these subwaves here. We know we have several degrees of valid wave patterns. But what's wrong with this count? Well, the wave 3 there's a couple things wrong. The wave 3 has come up a little short. Also, this looks kind of funny here. We don't have really the right look there. So what I'd like to do is just count this part again and look at some options. And this is the power of counting subwaves used in combination with the alternate wave counts. But I didn't really get any perfect counts out of this. This really doesn't satisfy me because it doesn't have the right look and it doesn't conform with the probability. Short wave 3s are tough to trust. So let's, just to make this clear, I'm going to, oops, I didn't want to do that. Let's just clear some of these wave patterns out so we can count this again. Okay, let's see if I can, again, this is in the same analogy as your search engine. If you're going to look for, if you're interested in old classic cars, you're not going to type cars into a Google search because you're going to get all sorts of stuff that you're not interested in. Here, now we've done a search on this entire section of chart by running a wave count on the whole period. We can use the counting subwaves to refine the count and look at some more options. Aha! Now this is something that's just, from experience, starting to look a little better. Not only do we not have this short wave 3 that we had before, look at this. We have a wave 3 about where we would have expected, nice, tight, wave, that the top of that wave, the top of that move hit, that wave 5 hit where we would have expected it to. This is a much better looking wave count. Now we see, and this is an open question I touched on earlier. Looks like we have 5 waves down from that wave 3, which would most likely be at wave A. So we have, not only we have those 5 waves down, but we haven't gotten as low as we would statistically expect to get for wave 4. So based on this wave count, we would expect a bounce and then a drop, bounce for wave B, then a drop for wave C to finish this wave 4 around 27 and change before rallying up for wave 5 up there. So let's put this up in the box where we can expect it. Sorry if this gets messy. And Maria, you'll let me know if any technical issues happen, right? If my audio or something is not right. I should have said that a while ago. So now we would expect moving forward to complete this drop for wave 4, then rally for wave 5. Now the question is, well, where does that put us in the context of this next higher degree wave pattern? So we're expecting, we have our 1, 2, nice and solid where we would have expected it to be. Where are we going to expect wave 3? Well, now look at that. Now we're starting to get into the next slide, the next topic. So what we see here, this is referred to again as confluence. As I mentioned this before, we have confluence here at 2 degrees in this section of the chart. At 2 degrees, we have overlapping probability where we would have expected the bottom, the turning point to occur. And sure enough, it happened. Same thing here. We're only here. We have plenty more action to take place. We're expecting a bounce, then a drop, then a rally. And we already have the confluence that we would like to see here for wave 3. So I'll tell you, I don't like to sound too passionate, but I'm shocked that in my life I get to see what I consider miracles every day, because here this is a miracle. You're not supposed to. We're trained to believe that it's not possible to predict the future, but I see it happening every day, all day. So I would not be at all surprised. Anything can happen. Maybe this can be counted a different way, and we'll look at how to assess that. Maybe this wave 4 is already finished. Maybe it's not going to get down to here. Maybe we're already starting to rally in wave 5. But it wouldn't surprise me one bit if we did exactly this, because it happens more often than it's supposed to. It's really, I absolutely love this stuff. If like I said, I don't want to sound like a crazy man, but I've seen just so much data and I've seen so many wave counts, and it's just, I really want more people to be able to benefit from this. So, so let's, let me flip through the questions here, see if anything came up. I think I mentioned that at the beginning. Any questions that you have that aren't directly related to what we're talking about today, please send to us on customer support. This is not a place to get customer support. We're not talking about those sorts of things. We could be here all day. We're really right now focused on how to apply the principles of Elliott wave analysis and how to use wave basis to do it. So I'm seeing some questions here that just don't have anything to do with what we're talking about today. But with that said, I don't want to ignore you. I don't want you to feel ignored. Send us those questions on customer support. We'll be happy to answer them. So choosing the right wave count. Now, the next up, how do you analyze multiple time frames? And this goes back to where we started. You're going to always be working from a single long-term wave count, and you're going to zoom in on time frames. And I make that point because one of the other mistakes that a lot of folks make is that we'll run a wave count on a daily time frame, and then they'll run exactly the same wave count from the same starting point on a 60-minute wave count. I'm sorry, a 60-minute time frame, and then they'll be confused. They'll start to try to compare the two, and that's not how Elliott wave analysis is practiced. And I would say it that way because this is not a wave basis thing. Elliott wave analysis, from its very beginning is intended to be practiced exactly the way I showed you. So this is not coming from me. This is not coming from wave basis. You start zoomed out and then you zoom in on that same wave count. This is incredibly important. And you will find that once you're comfortable with that process, it will be life-changing in terms of understanding what's going on with patterns. Because I can still remember when I was getting used to looking at this. This looks crazy, numbers and letters and lines. What is all this? It can be hard to get used to, but that process is greatly facilitated when you understand the big picture. Long-term wave count, then zoom in. And what you're doing is you're identifying the primary trend at the higher, when you're establishing that long-term context, as we've talked about, you're identifying the trend at the higher time frames. Then what you're going to do is you're going to analyze the intermediate trends at medium time frames. You're going to pinpoint your entries and exit points in lower time frames. And as I said at the beginning, this will be dependent on your trading time horizon. I don't think I emphasized that on the previous slide. Did I mention that? Yeah, it's important. And this is something that maybe, especially newer traders, deciding on your time horizon. You have to decide, before you go too far with your wave analysis, decide, well, how long do I want to be in a trade? Am I looking to trade something over the course of the day? Am I, do I want to sit on some options for a couple of weeks? Do I want something longer? Decide that and allow that to drive your wave analysis. How far do I need to zoom in to meet my trading time, my time horizon objectives? So this is the analyzing intermediate trends and medium time frames. This is the zooming in process, and we're going to look at that in a minute. I've already shown several examples of this, of how to use a smart support resistance tool to identify confluence. And go back. Double clicking when I shouldn't be. The concept of confluence, again, is a core essential aspect of Elliott wave analysis. One of the things that is particularly powerful and useful with wave bases is you have these pretty colored boxes that make it really easy to find confluence. When you see different wave degrees projecting the same price targets for a support area or support or resistance areas, this is extremely powerful. This is a central Elliott wave concept, greatly facilitated by wave bases, the smart support resistance tools. I want to keep emphasizing this because I'm surprised at how many newer wave basis users aren't using them. The smart support and resistance are extremely powerful for the reasons that I've mentioned. It's real probabilities based on real data, and it's up to you to use them and interpret them as they're intended to be interpreted. And I mentioned earlier, be flexible and allow the market to inform you and adjust wave counts as needed. And again, that is also, I'll qualify that last bullet point to be dependent on the time frame that you're looking at. So if we're talking about your long-term master wave count, like I have my long-term NASDAQ wave count here, I'm not expecting any major changes here on a day-to-day basis. I might go and update this at some point. If this continues up, I'll know that I'm going to assume we're still in the wave 5 up. If it drops meaningfully, I'm going to assume that 5 wave move is done and something else is going to happen. But that's over a period of days, weeks, or months. I'm not going to touch this wave count. If you're looking at a 5-minute wave count, like for example, the QQQ count, I'm going to be updating this pretty frequently, and I'm going to be updating it. Same way I'd update my forecast on a hurricane, I'm going to update it to adjust to what the market is telling me. So here we have this. Just really quick, I'll look at this. We have this 5 wave, presumably a 5 wave move up. We're above where we would have expected that wave 5 to occur. This is the wave 5 I'm talking about. This, I'm just taking a quick aside to lead into multiple time frames. This is that wave 5. We're higher than we would have expected. And so as I mentioned before, this tells you that wave 5 is late. It's late. That can inform you that it's overdue. So be alert for this wave 5 to finish. Not only is it already overdue, but we have what looks to be a pretty solid 5-wave move up happening. So we have this little 5 waves here, the yellow 1, 2, 3. Wave 3 hit right where we would have expected it to. We had a short wave 4, and let's look at what that tells you. So we would have expected, somebody say something if you can't see. I know this is kind of small and cluttered. This is my sort of working chart. It's not really a presentation chart. It's what I'm just working on because I'm trading QQQ. We would have expected the wave 4 to get down to here, and it didn't. When wave 4s are short, they typically hit around the 236 Fibonacci retracement. And what that tells us in more sort of practical terms is short wave 4s generally tend to inform you that we're if you didn't already know, we're in a strong rally. The crowd, the people who are driving this are excited to keep it going up. They didn't need to wait for it to drop. Again, this is not a random thing happening. This is people feeling something about the market and making decisions based on their feeling. Again, I hope I don't say that too often, but for me, it really helps to remember that this is not some random thing happening on my screen. This is, you can get information about the crowd. And, we're planning, I'll tell you some of the things we're planning. We're planning to put more information about these sorts of things. Some of the things that I mentioned, these sort of secondary probability occurrences like this 236. We have other values for corrective waves, A's and B's and things like that. There's plenty of this in other places on the internet, but there is also, it's important to understand the personalities of waves and what the psychology of what's happening during the wave. For example, in a wave 4, what we understand is that all the people who caught this wave 3 are now taking profits. There's a bunch of people taking profits. Boom. That's that's why wave 4s are wave 4s. And during that time, there are a lot of people who kind of missed this, or maybe they got in late, and they're thinking, well, I think maybe it's going to keep going up. So there's sort of a renegotiation happening in a wave 4. Wave 4s tend to be messy because of that. There isn't a crowd agreement. It takes time for the folks to get agreed. Okay, yeah, we're going to keep going up. That's, this is what I mean. What is meant by wave personalities. There's real psychology behind what's happening in these patterns. So let's take a look at the silver count. Again, let's go back to our slides. We know what we're talking about. So we're going to look at this zoom in process. Silver count. Actually, instead of the silver, we're just going to do silver. Well, yeah, we will do silver. So this is our daily count. It's messy there. Let's take this down to 60 minutes. And you can see, last time I counted this was a couple of days ago, and I was thinking, well, looks like maybe wave 4 is going to stop there, and it didn't. We're continuing to drop down. In this particular instance, I was on alert, as I just covered in QQQ, for a short wave 3 and an excited rally to complete the rest of the pattern with wave 5. That didn't happen. And what we would expect here is that wave 4 is going to end up down here somewhere. And so let's actually, let me let's recount this. And so, as I just mentioned about wave 4s, it's known in LA wave analysis that wave 4s are typically going to be messy. There's going to be whipsaw. And my personal trading style, I don't get involved in that. I don't tend to trade wave 4s. Some people have more personality to trading in chop. I don't like to trade chop. I trade probability. Chop, it tends, it's whipsaw. The probabilities are naturally mathematically diminished when markets are in this kind of phase. So my personal style is I'm just going to wait for this to finish and give me some confirmation that it's going up. So how do I know that it's going to? How do I know, or how can I begin to try to get a sense of when that's going to be done? That's the way forward that I want, is out in the future here. I'm not going to consider this the alt anymore. This is the count I'm tracking. I'm going to turn off my alternate label, and that's just so it's easier to see. Let's clear that out. I'm going to clear the subwaves. It doesn't clear waves that you've drawn. I drew those waves, so I'm going to delete those. So, and I didn't talk about that this time, but we're going to do more of these webinars. I'll talk about using, Wavebase is intended to give you a lot of automation to rely on, but sometimes you do want to draw your own waves, and I do that all the time. So I'll talk more about that. Now we're going to count this. This is nothing is too clear about this. It's full of overlap. It's just an ugly mess, which is why I don't intend to get involved in it. But what's the best we can get out of this? Well, let's see. We kind of have it looks like a 5 waves down for clear out some of the noise, so it's a little easier to see. Oops. Yeah. Looks like we have 5 waves down, could have 5 waves down for wave A. And this is one of those other sort of secondary probability levels to look for. In this case, this is in a wave 4. Very often, the wave A will get to the 236% retracement, and it will bounce for wave B. And now we'd be looking for a wave C down below. Highest probability place would have been here. And this is a great example, because I've shown you places where you get confluence, really real clarity in terms of the probabilities. Here we're not getting that confluence. We see that wave 4 projects to this area here. Based on this wave B, wave C would project here. There's some lack of clarity there. Again, typical for a wave 4. Which is why I'll say it again, which is why I don't trade them. So maybe we're going to get some sort of ending diagonal here. Maybe this is even a complex corrective XYZ. We'll talk about that in another webinar too. Why currently they don't appear in automatic wave counts. But what we'd be looking for here is some sort of clarity to emerge. And in my case, based on my approach to trading, as I would wait for it to settle down here, or at least show me a 5-wave move up on a 15 to 60 minute chart, followed by a 3-wave correction. I hope I'm not confusing. I didn't need to go too much into this sort of thing. But if I'm itching to get long silver for some reason, what I'm going to wait, ideally, I'd see it down here in this kind of hot spot, and then we get a 5-wave move up, 2 waves back. I'll enter on that. Here, I'm not seeing that yet. This is still kind of messy. It looks like 3 up, probably still in this messy chop. Now looking, I'll go a little bit more. I look at a market that's a little clearer in terms of how to. But before I do that, I'll say that depending on the market and how I'm trading it, what my time horizon is. For example, some markets I do just long-term invest. I'll look for decent places to add to a long-term position. Some markets I trade actively on a short-term basis. And so how, this is just touch on how I use the Wave Basis workspace. In the case of silver, I don't really trade too actively. I do some stuff across the metals and miners, shortish term options. But more than anything, I just want to keep my finger on the pulse of the long-term count. And I may use this same chart like I just did in the example. I'll zoom in 60 minutes to see, how likely it is that we've already completed this for that sort of thing. In cases where, and so I do all of that work on one chart. This is just my personal workflow. Feel free, as you hopefully have already experimented with, there are lots of different chart layouts you can use depending on how you like to look at stuff. I tend to use 2 to 3, I'll look at Tesla today, 2 to 3 charts. So once I have the long-term wave count, in the case of Tesla, we can take a look at that. And I talked about Tesla, I don't know, a year or two ago, and this is exactly the same wave count. I have not rerun the count. I just pull it out of my saved charts or whatever. At that, I think the last time I talked about Tesla, we were around here somewhere. And I was looking for, we don't need the indicators on here. And I was looking for a bottom around 150. Based on, I don't actually remember. Maybe that was in here. I was looking for this bottom. I don't know. Anyway, at this point, I was expecting a bottom in this area. Again, one of my favorite things in Wave Basis are these smart support resistance areas. It got in there and spiked out, but we're calling this a deep wave too. So in this case, rather than zoom in on this chart, I am trading Tesla short term and long term. I will split it out into a separate chart. And this is similar to what I showed you with the NASDAQ, where I'm not looking at that CompX.X full history NASDAQ all the time. I will keep the longer term wave count, especially on something like Tesla, which has a pretty short history. I can see the whole thing on one panel. And then I'll zoom in. So this area here is now on this second 60-minute chart, where for me, I like to be able to see where we are in the longer term, higher time frame context, and keep a closer eye on what's happening in the shorter term time frame. So again, this is the same wave count as this wave count. I have not started a new wave count just because I switched to a new time frame. I've taken this chart, I've taken this and just transposed it here and did a new wave count. And we can do it again. See where we are. Okay. So again, based on that, I'm expecting a drop to about 160, and we'll see. But in any case, you may have observed that I'm bullish Tesla. Okay, let me see. So I hope that gives you a good solid footing. Long-term context, zoom in as you need it, evaluate wave counts using the tools of Wave Basis and standard accepted ways of assessing wave pattern. One of the great things about Wave Basis is you can be sure, if you're doing this, for example, the traditional way by hand, you have to keep the rules in mind and measure out all your wave patterns and make sure they're valid. You don't have to worry about any of that in Wave Basis. All the wave counts are valid. You just have to assess them using simple tools like this, support resistance, fibs, channels, that sort of thing. And use your brain. Does it look crazy? If it looks like a crazy pattern, we all understand that the ideal pattern, well, hopefully most of us at least understand that the ideal wave pattern looks like this. 5 waves up. So that's what you're looking for. That's what you're looking for. And then you're looking for, oops, my fingers are going crazy. This is what, it's referred to as the right look. If you're seeing something that doesn't at all resemble that, this is in the I refer to this as the signal. Not the trading signal. In market data, you have signal and you have noise. This is the signal. If you're not seeing something that looks like signal, if you're not seeing something that looks like that, go to another market. There are lots of markets, unless you're forced to trade a market. Look for signal, find the pattern, because they exist and they're all over the place. I only trade a handful of markets, and the expression I use is something is always setting up, always. You don't need a screener to look at 500 markets. This is what people do that are casino gamblers. You don't need that. And you're looking for a rebound over and over and over and over again. I've shown you some of these examples. It actually happens all the time. You just have to be looking for that. Look, that's what you're looking for at every degree of scale, all time frames. It happens over and over and over again. So I guess I'm sort of replying to one of the questions somebody asked. Well, what's clarity? What you're seeing right here, that's clarity. You're looking for your markets to look like that or something close to it. And close to it can be measured by using probabilities. What I just drew is close to it. It's not exact. You can see where we would have expected my wave 4 to be, where we would have expected my wave 3 to be, where we would have expected my wave 2 to be. What I just drew wasn't perfect, but it was really close to what the statistics say it should be, or the probabilities say it should be. So I hope that answers that question about clarity. What are we're at 90 minutes now. I don't want to drag this on too long. I know people get distracted and everybody has stuff to do. So let me just scan these questions, see if anything that really is relevant to what I'm talking about now. Somebody figured it out. I think I might have gotten. Somebody asked, does the bias feature make all alternate counts bullish or bearish aligning with the primary count? No, but you might find that happens frequently. It's not built in, and it's not an assumption that you should make. One of the things I didn't mention about the interpreting the alternate wave counts, guys, I started talking about these percentages. The percentages that you see in the alternate wave counts gadget is a measure of how similar the alternate counts are to the primary count. And that's just, kind of a convenience measure. These are not probabilities. It's what we have coined the term similarity index. And what that can tell you is if you're considering if you're considering your primary count and you see that all of the alternates are highly similar to your primary count, that can be a confidence boost. If you see that your alternate wave counts are, these are very low numbers in some cases, and some of them are bullish, some of them are bearish, then what that can initially inform you is that maybe there's some lack of clarity here. And maybe I should look at all of these alternates counts more closely. Maybe I should even consider if there's not a lot of clarity, if there's multiple very different ways to count the section of chart I'm looking at or the market I'm looking at. Maybe it's going to be hard to get clarity out of that market. You're not always going to find the clarity that you're looking for. It's important to not force yourself to trade a market. It's also important not to expect magic to happen. There's no magic here. This is objective reasoning based on probabilities and looking for a signal. So just because you see 1, 2, 3, 4, 5, ABC somewhere on a chart, doesn't mean that that's clear. It doesn't mean that you should be trading that market. So I can't emphasize that enough. Look for clarity. Look for the signal. Look for what Ralph Nelson Elliott informed us about. Because you're not always going to find it at every time frame. You're not always going to find it at every time period, and you're not always going to find it in every market. But fortunately, there's tons of all of that to look at, and you can do it with the click of a button. I think that's it for now. Let me see to the bottom. So let me just go back to the. Almost forgot about the coupon. So I guess I'll wrap it up there. Say, I really thank you guys for coming. I hope this was useful and helpful for you. And I appreciate the enthusiasm. And there's a lot of questions here. We're going to go through these, and maybe some of these will end up as frequently asked questions on the website. As always, feel free to reach out to us at customer support if you have any questions. The coupon code, as you see here, WB June 2024. It will give you a 30% discount on a new subscription or an upgrade for the next 12 months. If you're interested in this discount, it will expire on June 14th. 48 hours. Get it while it's hot. And in any case, we're thrilled to have you, as it says here, as part of our community, and we look forward to supporting you on your trading journey. I hope this has, again, been useful, and thank you all for coming. Did I forget anything, Maria?
No.
Everybody still there? No?
Yes.
Did I forget anything? Are we good? No? Okay. All right, guys. Thank you for coming. And happy trading to all of you. Take care.